What is a mortgage? If you ever said to yourself, I need to get a mortgage, but secretly wasn't so sure what that actually means, you're not alone. Today, I'm breaking down one of the most misunderstood words in real estate in plain English. Welcome to Sue's Corner. Every week, we're going to be talking about real estate terms that buyers and sellers hear all the time and explaining it without confusing industry jargon. Whether you're buying your first home or your fifth, my goal is to help you feel confident every step of the way. So, what is a mortgage? Let's start simple. A mortgage is simply a loan that helps you buy a house. Most people don't have hundreds of thousands of dollars sitting in their bank account. So instead, a lender loans you the money to purchase the home, and you agree to pay the money back over time with interest. So, for example, let's say you buy a $400,000 house. You put $80,000 down. That means you borrow the remaining $320,000. That borrowed money is your mortgage. Who gives you the mortgage? Different people give you mortgages, such as bank, credit unions, mortgage lenders. As your realtor, I help guide you through the process, but your lender is the one who approves the loan. What determines your payment? The payment usually includes principal, what you borrowed, interest, property taxes, homeowners insurance, and mortgage insurance, also known as PMI. You'll probably hear lenders talk about PITI. That's just a fancy way of saying your total monthly payment. What affects your payment? Your payment changed based on interest rates, how much you have to put down, loan amount, loan terms, 15 years versus 30 years, your taxes, and your insurance on the home. So, two people could buy the exact same house and they could have completely different mortgage payments depending on their down payment and interest rate. One of the biggest myths I hear is that you have to put 20% down. Not true. While putting 20% down can help you avoid mortgage insurance or PMI, in many cases, it's absolutely not required. There are loan programs that allow qualified buyers to purchase with much less. So that is when we get a lender involved. That's when you tell them how much you have to put down, what you're looking to buy, and what you would like your monthly payment to look like. Now, let's talk about mortgage versus interest. A mortgage is the loan itself. An interest rate is simply the cost of borrowing that money. Use a car loan, for example. So let's answer a few common questions that people have. Do I have to keep my mortgage for 30 years? No. Can I pay it off early? Most oftentimes, yes. You can refinance, pay it off early. When you sell the home, that is also when you liquidate the loan. Can I pay extra? Usually, yes. You need to check with your lender ahead of time. Extra principal payments can reduce the interest rate over the life of the loan. Is getting pre-approved the same as getting a mortgage? No. Pre-approval is simply the lender saying, based on what we know today, this is approximately what you can qualify to borrow. The final approval happens much later during the purchase process and through underwriting. Now, why does this matter? Understanding what a mortgage actually is helps you make smarter decisions. Buying a home doesn't have to be intimidating when you're understanding the language. So if there are any other real estate terms that you've ever wondered about, please leave them in the comments below. I might feature you on our next episode of Sue's Corner. I hope this video helped. If you liked it, please make sure you subscribe and share with a friend or a family member who is thinking of buying or selling in the future. We'll see you on the next episode.